Good day. It's Debbie Thomas here in the studio. Welcome to TMG Television. Hopefully we have lots of viewers from across the country today. Good morning here in the West Coast. Good afternoon out in the East Coast, and I hope you're enjoying your lunch in the Prairie Provinces. My name is Debbie Thomas, and I'm a founding partner of TMG, and I'm proud to say we've been helping Canadian families for almost 22 years now. It'll actually be 22 years in June of this year that we've been helping Canadians with their home financing needs. TMG have over 900 mortgage specialists across the country. So if you're looking to work with one, you have any questions from a local TMG agent, you can go to our website, www.mortgagegroup.com. You can select your province and then simply type in a name, type in a city, type in a language, and it'll search and give you a list of those brokers that are available in your own neighborhood. I do intend to spend about 30 minutes today, just under 30 minutes actually, and talking about some mortgage rule changes and some clarifications on some of those changes, because there are still some misconceptions out there in the industry. And I just want to mention that I do have my, my trusty iPad here. For those of you watching, if you'd like to send a question live, it'll come into my iPad, and then I can try and answer that question while we are broadcasting live. So we'll get started. Misconceptions that when we first started doing this broadcast, I asked a lot of my brokers that work with realtors specifically, are there any misconceptions that you get on a regular basis that your realtors are saying, and you're having to correct those misconceptions? So today, some of those misconceptions are, can you still buy with zero down payment? Followed by, is there still mortgages out there with 40-year amortizations? Mortgage lenders, who are they and how do they actually differ? Does a mortgage pre-approval really allow you to make an offer without a financing condition? And finally, can you still buy property using stated income? Before we get into that detail, I wanted to take some time to review some of the mortgage rule changes that have occurred over the last 4 years. The biggest rule change actually occurred on April the 19th of 2010. So it's 2 years since we've had this rule. It was a huge change. The bank now has something called their benchmark rate. And if your client wants to take a 1 through 4 year fixed term or a variable rate product, we no longer can qualify on the 3-year rate. We now have to use the Bank of Canada benchmark rate, which today is 5.44%. So I did a little bit of number crunching, and I took a $300,000 mortgage, and I said if my client wanted to take a 5-year rate today, a 5-year fixed rate, I can qualify them on that 5-year fixed rate. That means at a 3.29% interest rate, my income needed to service that debt is only $49,000, just under $50,000 to service a $300,000 mortgage. But if my client wants to take a variable or a 1 through 4 year term, I now have to use that 5.44. So I'm now using income of $62,000 plus in order to get that servicing for the same amount of mortgage. So literally overnight, on April the 18th, 2010, someone could qualify using, $49,000 of income, and on April 19th, now they have to have $62,000 of income to qualify for that same mortgage. It's a 25% increase. So it's no wonder that the stats are showing the majority of consumers over the past year or so have taken 5-year fixed mortgages. It's because they have no choice. They do not qualify anymore. So that was one of the biggest changes that occurred. So I just wanted to clarify to make sure everybody knows that. Some other things that happened back in April of 2010, refinancing was reduced from 95% down to 90% loan to value, which is still high, and it's subsequently changed from that point. rental financing high ratio disappeared. So all of those people that could buy a revenue property with 5% down payment and put the minimum amount of skin in the game, they could hang on to that for 6 months or whatever, or if they were buying pre-sales in condo developments that weren't expected to close for 60 days, 90 days, or 6 months and a year down the road, they could put 5% down and perhaps flip the property before the completion even occurred. So the government said there are too many speculators out there. We've got to cut out this high ratio lending for rental financing. So that disappeared. So a lot less people out there buying investment properties, unfortunately, which is not good for the real estate industry or not good for being a mortgage broker. Minimum down payment was at 100%, or pardon me, at 0% down payment. In other words, you could get into a deal without having any money down. Well, the lenders decided, as well as the Government of Canada, there's just too much risk if nobody has any of their own money into the deal. So since that date, 2010, in April, we have had a minimum of 5% down payment. So let's now talk about some exceptions. And there are still cashback programs out there. In other words, I still do not have to have 5% of my own money down. There are a couple of ways that we can accomplish this. There are 3 lenders out there right now, those are national lenders that I'm speaking of, that have cashback programs. There are all kinds of lenders that have cashback programs, but those can't be used as the down payment. But Scotiabank, National Bank, and Laurentian Bank are 3 of the lenders that we deal with that do allow 5% to be used as part of the down payment. Now, the negatives, those lenders will not give discounted rates. If you plan on using their money as the down payment, plan on paying posted rates. So it's not always the best strategy. We're here to help the client making the lowest overall interest costs over the time frame of that mortgage. So actually taking a discounted rate with 5% down works out a heck of a lot better than taking a posted rate with 0% down. So keep that in mind. You can still get a gift, right? So 5%, mom and dad give the gift to kids who are wanting to buy. But what's changed over the last couple of years are those gift requirements. So not only is a signed gift letter appropriate, but we now have to show the source of where that money currently is. So in mom and dad's bank account, when mom and dad don't necessarily get happy with that, as well as we need to show that deposit being made into the child's bank account prior to the lender typically sending instructions out. So it's not as easy as it used to be. We used to just be able to throw a gift letter over to the lender, everything was cool. Now there's a little bit more due diligence that the lenders are doing. Not all of them, but the majority of them, and it's going that way more and more. CMHC, Canada Mortgage and Housing, if you have a high ratio mortgage, you can still qualify under what they call flex down. So it doesn't have to be my own money. I could actually borrow that money from a friend as long as the repayment terms are clarified. If I have a line of credit at my bank, $10,000, part of the down payment could become that line of credit. But just remember, I have to take a certain amount of money per month to pay back in my liability section, or the loan. If I've got friends that say you owe me $250 a month, I'd have to include that into my liability section for debt servicing. And I just wanted to remind everybody out there that even though we say 5% down, I have 5% down, I have 10% down, I have 15% down, we always have to add an additional 1.5 onto that. The lender always wants to make sure that you can cover what we classify as closing costs. All right, so if my client says, well, I have 5% down, we need to tell the client, you need to prove you have 6.5% down to cover closing costs, lawyer fees, moving expenses, tax adjustments, property tax adjustments on the property. Perhaps you may have, property transfer tax. I know here in British Columbia we have. I know other provinces have some type of of tax that they have to pay when title is transferred. Even though you may be exempt from those, the lender still wants to see that you have the capability of paying that if you had to. So, and the other thing, remember there's a 90-day rule. So that down payment that you have in your bank account that you're going to prove to the lender, we have to show a 90-day history that it has been with us over that time frame, that 3-month time frame. And that's to prevent somebody from, borrowing from John, his good buddy, $20,000, put it into the bank account, now take a copy of that, show it to the lender, and then tomorrow turn around and give it back to John. So again, that 90-day rule is quite strict that we have to abide by. So let's now move forward to March 17th of 2011. Now we've got refinancing that have been reduced to 85%, and it's been there now for, a year, and we hope that it continues to stay. And another thing that occurred is the maximum amortization was reduced from 35 years back in March, two years ago. We had 40-year amortization. Today, we only have 30-year amortization. Now, I want you to keep in mind, that is for high ratio financing only, all right? So if someone has less than 20% down, yes, they only have a maximum of 35-year or 30-year amortization, a minimum of 5% down payment. But we also have conventional lending that is still out there. So if I have more than 20% down payment, I do still have access to 30, 5, and 40-year amortization products. Now, most of the banks have stopped 35 and 40-year amortizations, but we still have non-bank lenders. And I'm going to get into non-bank lenders and who they are a little bit later on in the presentation. One of the little perks that we have as brokers is we can go to a non-bank lender and use some of the things that they can do that the banks can't. And one of them, which is very cool and helps us a lot, is again trying to get it wrapped around that benchmark rate when the client wants to take a fixed product, 1 to 4 years, or a variable rate product. We can go to a non-bank lender and we're able to use their 3-year rate. And non-bank lenders don't have posted and discounted. They just have their 3-year rate. So oftentimes we can get somebody qualified with a non-bank lender that we can't with a bank because the bank has to use 5.44 for qualifying purposes. So now let's move on and talk about lenders. Who are they and how do they differ? We have chartered banks, the big 5, as well as ING Bank, as well as Laurentian Bank, as well as Bridgewater Bank. So there are all kinds of lenders banks out there, but for all intents and purposes, those banks are all regulated by OSFI, okay? And that is the Office of the Superintendent of Financial Institutions Canada. And a little bit later on, I'm going to show you a paper that they've drafted up is giving all of the lenders out there a draft recommendation on some additional changes that should be made to the mortgage industry, and they're kind of scary, so I'm going to save that to the end of the presentation. Chartered banks regulated by OSFI, they've recently gone in and done audits in lots of the major banks. So lots of the major banks have really tightened up on their lending practices. Some of them have gotten rid of their stated income programs altogether. So it's been a really sort of a shifting of what's been available out there for the past 2 years. We're finding that a lot of the banks have tightened up and it's tougher to get mortgages approved. We also have credit unions, local credit unions, and they're great because oftentimes they have knowledge of smaller communities or knowledge of leased land in the area, or perhaps native leased land in the area that no one else will do, but a local credit union will because they're more involved in the community. So we as lenders, as brokers, look at the entire picture or the entire file, and it might be the best fit for someone to go to a credit union. And then finally, we have monoline lenders. They're regulated by provincial bodies. So keep in mind, credit unions and monoline lenders are not under the OSFI hat. So they don't necessarily have to do what OSFI asks them to do, because they're regulated here in British Columbia by the Financial Institutions Commission. In Ontario, there's another regulating body, and so on across the country. So let's now talk about the lenders and what they can and they cannot do. High ratio, everyone's the same, whether it's a chartered bank, a credit union, or a monoline lender, all right? The deal goes into the lender approves it, whether they like it or not. It's then turned around and sent into an insurer, one of 3 insurers, and I'll talk about those options a little bit later. When conventional deals roll into a bank, they don't have to, they can approve that deal right there on their desk, and certain individuals have lending authority up to $500,000, and so the underwriter can really look at the deal and make some exceptions, right? They can say, well, this guy really hasn't been on the job long enough, but that's okay. His credit is strong enough, or perhaps there's been some blips on the credit bureau, but we're able to mitigate those with the fact that he's gone through a divorce or something. The buck stops at the door conventionally at the bank. So oftentimes they can approve things by making exceptions. And good Lord, we as brokers are always asking for exceptions, because we very rarely get in a deal that's black and white. There's always something. There's always some type of challenge. And I think it's important for realtors out there to know that we get into the nitty-gritty. We get into credit history, we get into all kinds of stuff that pop up on a file that becomes a challenge, and we do our best to fit it into a lender that has the ability to make some exceptions on those files. Credit unions, same thing, we get some exceptions. Where monoline lenders are different, and I'm going to just clarify, a monoline lender is a non-bank lender. A monoline lender definition is they do one thing. They do mortgages. They don't sell RRSPs, they don't sell credit cards, they're not trying to cross-sell your client. If your client goes with a monoline lender, it's basically an auto debit that's taken out of an existing bank account. They don't have to go in and sign up, and lenders often, banks often cross-sell. That's how they make their money. So monoline lenders are abundant out there. I can list MCAP, First National, Merrick's Financial. I can't think of them anymore off the top of my head, but we keep those monoline lenders alive because they only market and sell to the broker community. So oftentimes they put together products that are the best of the bank. They get rid of what the issues are with the bank mortgage, so there's oftentimes better prepayment privileges, less payout penalties. The way they charge payout penalties, there's no such thing as posted rate versus discounted rate. So we use monoline lenders very, very often. Now the only setback or drawback for some of the monoline lenders is, even though it's a conventional mortgage, those still have to be insured, and we call it bulk insurance. So in other words, when I send a deal in to a monoline lender, they still have to send it into CMHC or Genworth for approval. Now, the premiums that are charged by the insurer, the lender picks up those costs. So really it's something that happens in the background that your clients don't even know are happening. But don't forget, we can get 40-year amortization with those monoline lenders. We can use a 3-year rate, their discounted rate for qualifying for a variable in 1 through 4. So we have lenders that are, debt servicing, are a little easier on debt servicing, and so oftentimes we can get something done through a monoline that we can't get through a chartered bank or a credit union for that matter. So let's move on now and talk about the insurers. So when I do have a high ratio deal, I have to send it into the lender. The lender then has to send it into CMHC or Genworth or Canada Guarantee. As I said, we do have 3 insurers. Now, not all lenders deal with all three insurers. And so when we get a deal in, we have to, it's like a jigsaw puzzle. We have to determine A, which lender is best, B, which insurer has policies and guidelines that will allow this deal to fund and to fit into the box. So what we've noticed over the past 6 months is Canada Mortgage and Housing, which is a federally owned company, have become very, very, they've really tightened up. So typically, we've been able to send a deal into a lender as long as less than 44% of our gross monthly income went toward our principal, our interest, our taxes, and any other debt. That was fine. So we could go up to that number without any problem because both the lender and the insurer had that policy. But we've seen lately that when we've sent deals in that are close, anything over apparently 35% now, so spending more than 35% of our gross monthly income on that mortgage payment and other debt, anything that's gone in above 35 is really getting challenged to be approved. So there's a higher level of scrutiny. Oftentimes a lender will approve that deal, but the insurer will come back and say, you know what, we want more debt to be paid off, or we want this credit card gone, or we want more down payment. So we're seeing that more and more. We're also seeing property values that are softening. So keep in mind, if you're out in a bidding war and you're, as a realtor, you want to go in with a clean offer, you want to go in over list, we still have to get an evaluation. The majority of appraisals these days are all done automatically. We very rarely have to send appraisers out. Most of the banks have auto evaluation systems. Same with monolines. They use the insurer's automated program. And so appraisals, what you have to remember is if you do something over list, that appraisal comes back, that valuation comes back based on comparables. So if you're the first one in the neighborhood to buy something over list, the record or the comparables may not be in CMHC's records yet or Genworth's records yet. So you may have a value that's come back underneath, $10,000, $15,000 underneath what you actually paid for. Keep in mind, the client's going to have to come up with the difference in cash because the lender only lends based on the lesser of the value or the purchase price. All right? Basement suite income. CMHC only uses any of that income if it is a conforming or a legal suite. And I know here in British Columbia we have all kinds of non-conforming basement suites because the property values are so high. If someone were to put an offer in on a home and needed some of that basement suite income, or it was a duplex and they needed some revenue, that becomes imperative that we find a lender, A, that uses that income the way we want it to be used, and B, we have a lender that is hooked up with both CMHC or Genworth or Canada Guarantee because the insurers use that income differently. The other thing we found with CMHC is they've really shut down the business for self programs. So it's a very small window now, and I would say that the majority of brokers who are trying to get business for self or self-employed individuals approved, because oftentimes, they write expenses off, and so they don't have, Government of Canada income to prove the deal. There are some other programs that we can approve them in, but CMHC's program is pretty much gone. So let's now move on to Genworth, and it really takes some time and some thought when we're looking at a deal. Genworth really have no restrictions on basement suite income. So in other words, they'll use up to 80 or 100% of that basement suite income, whether it is legal or not. They do not care. And so that's huge. So we have to find a lender that will send it to Genworth, a lender that will use 80% direct rental offset to get our numbers working, to make sure that we're still under 35% in our debt servicing ratios. Genworth also has no issue with age-restricted properties. There's all kinds of developments out there right now that are for, well, I guess seniors, 55 and older. I don't like to say seniors at 55 and older because I'd probably fit into that. Well, I do fit into that category. No restrictions on age properties. So CMHC couldn't go to get financing there. We can turn around and send it to Genworth. That will work. Genworth also has discounts on GE appliances. So, it's kind of a cool perk to be able to tell your client that they can go in and buy any, stove, fridges, washer, dryer, any appliances. It's cool that they can go in and buy them at discounts because they've dealt with Genworth. Genworth is also far more flexible on their debt servicing ratios. So remember when I said TMHC is getting really strict on 35% and above? If I had a 38, a 40, a 42, a 43% debt servicing ratio, I would make sure it goes to a lender who in turn would send it into Genworth to get it done. They also have a very good debt management program. In other words, or a default management program. If you have put a client in a year or two ago into a high ratio mortgage and Genworth have been the insurer, this goes along part and parcel with you as brokers and as realtors, how important it is to contact your clients on a regular basis. How are things going? Realtors, the market is really keeping pace. You'd be glad to know that your property has appreciated X amount % over the last year or two. A broker would phone and say, how are the mortgage payments going? Are you able to make any double ups? And if the client comes back to say, oh man, I'm struggling. I actually missed my mortgage payment last month or 2 months ago. Genworth is great at putting together a program so that the home won't be lost to the lender for missing. Genworth also have new to Canada programs up to 95% loan to value, whereas CMHC is only 90% loan to value. And again, the business for self or self-employed individuals, we have a bigger window or a bigger box. The only thing I need to caution is that business for self is a buzzword that's come out lately is reasonability. So probably for the last 18 months to 2 years, we have been said, is this reasonable? Because when you're doing a stated income file, we typically just put in income that, we'll say to the client, all right, what is your gross income? And that is what we might use for debt servicing purposes. We don't have to prove they make that income, but we need to make sure that their income in there is enough so that the debt servicing ratios work. Because a normal, a self-employed individual typically deducts all kinds of expenses, so at the end of the day, their net income never works in order to qualify for a mortgage. So reasonability is becoming a big word out there right now that we're dealing with and we're struggling. And so typically now, if someone says, yes, I am self-employed, we would have to go to a website, for example, careerowlresources.ca. We would go into the salary finder, and if someone said they were, an electrical engineer, I could type that in, say they're under contract as an electrical engineer in the Toronto area or in the Halifax area. I can plug that in. It's going to give me an average wage. It's going to give me a high and a low. We have to make sure that what we put in that application for business for self is within that range. If we put in $200,000 just because it makes the deal work, and the engineer really grosses $220,000, but net say 110, and my reasonability scale is not within that, the lender and more importantly the insurer is going to kick that deal out and it will not get approved. And so as a broker, again, we have the ability to go to alternative lenders, and our slogan actually is think outside the branch. Because of all those monoline lenders and those credit unions, we can find lenders that will use the child tax credit, that will use maternity income if someone is on mat leave. We'll use 100% of that maternity income as long as we get a letter confirming that they're going to be back at work, eventually. We can use some add backs without any issues. We can do we can go to a lender that will use the maximum rental offset if there's a basement suite income. Or if the client owns other revenue properties, we can actually have them debt service properly because we know what lenders are best. It's a monoline lender that's best using clients that have 2 or 3 or 4 different revenue properties in order to get this all to work. We still have extended amortizations, right? Up to 40 years we can do it if it's a conventional purchase. And again, let's find a lender. If your client's really wanting a variable product, then we've got to go to a lender that's only going to use a 3-year rate for qualifying. So again, we as brokers, we know the whole picture, and we really pride ourselves in fitting that piece of the puzzle together to make sure that we can get your deals done so subject removals happen on time, you make your deal come to fruition, and so do we. We get paid by the lender, by the way. There's never a broker fee charged. This business is still young. We've been, as I mentioned, doing it for 22 years, and are very proud that we provide a service for your clients to make sure that they're finding a product that has the lowest overall lifetime cost. So now, let's move on to pre-approvals. In today's age, can you make an offer without a subject to financing clause? I just want to clarify, a pre-approval is usually, most likely, a rate hold. That's all it is. It's a 30-day, 60, 90, or 120-day rate hold. We can get up to 4-month rate holds. But the lenders are so busy, they don't have time to look at the credit. They don't have time to look at the employment and confirm the employment. And they haven't even seen the property yet. So if you go in with an offer that is not subject to financing, please make sure it's subject to something. A home inspection, an appraisal, viewing of the strata documents, but something that allows an out in case we can't get the financing done. In case you make an offer on a property that perhaps there's an issue and the lender knows about the issue, or it's lot value only and the lender's not comfortable with an old tear down. I mean, there's all kinds of things that could happen. The employer says to you, or the client says to you, I make $70,000 a year, but you neglected to figure out that $10,000 of that is overtime. I mean, just things like that happen. So please make sure, and we're requesting, I guess the norm these days is to give us a minimum of 5 business days for subject removal. Now, having said that, there are some great monoline lenders out there that can do subject removal in 24 hours, get mortgage instructions out in 48 hours, and close in 4 days from the time we first get the deal in. But of course, if we had to do those every day, none of us would have any hair left, and we couldn't sleep at night. So just in general terms, 5 business days for subject removal is great. Now, I wanted to talk about some trends that are happening out there right now. We all talk about what's trending out there on the internet. I'm seeing across the country here that insurers are tightening up. They're looking closely at the deals. They're often coming back wanting more down payment, wanting more debt to be paid off before they're comfortable with funding this. Values are coming back. Again, I mentioned bidding wars are happening across the country in certain locations, so you've got to really be careful in terms of financing on those, because your client may end up having to have more down payment because the loan to value is based on, again, the lesser of the purchase price or the appraised value. And here's one that is so common, and this is a big thing that happens, and that's strata issues. So, first-time home buyer, they can afford to get into a strata unit, a condominium, a small townhouse. If there is anything at all mentioned in the offer, anything at all mentioned in the property disclosure statements, everything's supposed to be disclosed if it was the previous grow-up, and of course we've had lots of those here in the Lower Mainland. If there are issues with having to, repair a roof or putting cement down in the garage, like why? Make sure we have 6 to 12 months strata minutes sent to us as soon as there is an issue. As soon as you see something on the offer or the property disclosure, we need to have 6 to 12 months strata minutes and 2 years of the annual general meetings, as well as the estoppel certificates, or here in British Columbia it's the Form B, because the lender is going to want to see what's going on. Oftentimes the client doesn't even see those before removing subjects, or an offer's written up where they're not reviewing. And of course, you as realtors know that some things on those strata documents can actually hold up the lender approving things and hold up the funding. And so very, very important that we see those as soon as possible. And I just want to, before we finish up here, I just wanted to remind everyone out there that, the media promotes, and we hear 2.99 best rate, 2.99 best rate. So everybody runs to try and get 2.99. It's not necessarily the best product at 2.99. It had major restrictions, and of course I wasn't going to put BMO up there, but everybody knows it was BMO. It had major restrictions, minimal down payment. You couldn't transfer it to new property. You couldn't pay it out early. Couldn't do a refinance. I mean, it was a very, very tight product. So we found that the majority of our clients going with a 3.09 with a fully featured mortgage was far better off. And so I guess the rule here is, let us do our job because we know what's best. Again, we look at the big picture. Are you planning on moving? And just as well as realtors look at those at that big picture. We try to put a strategy together to make sure that you have the right mortgage for your particular situation. And so you may be paying 10 basis points higher on the onset, but look at all of the costs you've saved down the way because you can take advantage of a full featured product. So just finishing up today, OSFI has released a draft recommendation which was sent out March 12th of 2012. It's currently open for public discussion. And our national organization, Canadian Association of Mortgage Professionals, are addressing this document because there are a number of things on here that we as broker community don't like. They're saying no more cashback mortgages. They're saying forget you monoline lenders using a 3-year rate versus the benchmark posted. Somehow they're going to enforce to all the monoline lenders that they can't do that anymore, even though they're not regulated, so I'm not sure how that's going to work. Here's the one, the loan to value has to be recalculated on renewal. Now, that's to protect the lender, so if it was 5%, if the lender had lent 95% initially, on renewal after 5 years, a new appraisal would have to be done to confirm that that equity of 5% is still there. If it's not, it's suggested that the owner is going to have to go and find the money to pay back, to get it back to the 95%. Now, no worries when we've got rising housing markets across the country, but a bit of a worry if we go the other way around. So that's something that we're really fighting against. They want home insurance to be reflected in the TDS calculation. Currently it is not. They want the exceptions conventionally. Remember we talked about conventional, everybody has an exception, makes an exception. They want to limit and stop those exceptions, so there's a black and white rule. Currently HELOCs, home equity lines of credit, currently we can borrow those up to 80% of the value. They want to cut those back to 65. They also want to not allow interest-only payments on HELOCs. And after 5 years, you now have to pay back some principal. And then they want to basically can all of the stated programs. So some new immigrant programs, equity lending programs. There are 2.67 million Canadians that are self-employed, and so you'll now have to use income based on your T4 or your T1 general, and that's just going to kill, well, 2.67 million Canadians trying to purchase homes or upgrade homes, sell homes, et cetera, et cetera. So we again are really fighting against some of these recommendations, and I think Jim Murphy, who is president of our national organization, has had a number of meetings with the finance minister to, you know, put our thoughts and perhaps a little bit of pressure on not passing or going forward with any of these. So I guess to finish up, thanks for watching, and I just want to remind that using an independent mortgage specialist, we can have knowledge to get all mortgages approved from all different lenders. If you go to just, you know, one referral source who uses a particular bank, they only have 3 or 4 products within that bank. They can't go outside and use maybe different types of income. They can't use their 40-year amortization. So not all clients would fit into a box. So I'd like you to keep the mortgage group brokers in mind. We think outside the branch, as I mentioned before, that's our slogan. I'd just like to thank you for watching. If you have any immediate questions that I haven't answered for you today, you're more than welcome to email info@mortgagegroup.com. It will come into me. I can pass it on to anyone across the country. If you're emailing in from you know, Halifax, I'd be more than happy to send it to one of our local specialists. And again, if you want to find someone in your neighborhood, log on to the mortgage group, select the province, type in the city, and you're going to get a list of our very well-trained mortgage experts. And our job is to help your job sell more properties, put more money in your wallet, and of course putting the client first. And that's always been our philosophy, putting the client first, doing what's best. So thanks for watching, and we'll do this again in 3 months or whenever some additional mortgage changes come up. Bye now.